So good evening. So let's wait for about 5 to 10 minutes so that our colleagues will join. Then we will start today's discussion. So we will wait for about 5 minutes so that our colleagues will join and then we will start. So you can put all your questions at the comment section and then I'll respond to all your questions. So please, once you join, try and then share the link, okay, on your maybe your status or something. Okay. So 11, 3 minutes for us to start. 3 minutes more for us to start. Okay, so guys, let's start. Please let me know who and who is here. Can you say hi to me on at the comment section? Then I'll know those that have joined so far. Okay, so in Forex, as we all know, when you open the chart, you need to understand the chart. You need to understand the language of the chart, and that is what is going to help you to analyze the market. So we've learned a lot already. Now, I want to focus on how to analyze the chart, how to enter into a trade, and then the most important things that you have to be looking out for. So we need to master, or you all need to master the candlesticks and then the candlesticks patterns. So whenever you see any of this candlesticks pattern at a specific point on the market, you will know whether you should buy the market or you should sell the market. So I think that that is the most important thing that most of you will have to master. And then after that, you also have to master trading psychology. So you must be able to, learn more on trading psychology, because your success on this market is is dependent on not only your strategy, not only your understanding on the market, but also your understanding of trading strategy, psychology, and then how you should master that, and it's going to help you make decisions when to enter the market and when to exit the market. So um, most of the time, when we analyze the market from the higher time frame to the lower time frame, I've established that we always will have to look out for a chart patterns in the lower time frame. So when you change your chart from the higher time frame, for example, the 4 hour time frame, to the lower time frame, like the 15 minutes time frame or the 5 minute time frame, what you are going to look out for is market structure, confirmatory candlesticks, or reversal candlesticks. That's what you basically will be looking out for. And so, first of all, after you have to demarcate your levels from the 4 hour time frame. So, for example, we have this particular area considered to be a demand area in the higher time frame. And then we realize that when the market reverses and then hit that level, we saw a huge push to the upside. Market retest the same zone again, and after that, before the market starts pushing to the upside, we saw what we saw this particular candlestick pattern, these two candlesticks. One, the first one is bearish, followed by this a bullish candle of almost the same size of body. So the body of the two candlesticks are of the same size, and we call this a teaser bottom pattern. And anytime you see a teaser bottom pattern close to a demand area or close to a resistance area, sorry, close to a demand area or a support area, then you are looking out for a buy. And then as after the formation of this particular teaser bottom, we saw a huge spike of the market to this side. So this is an example of a confirmatory reversal candlestick. So you need to, master it. Your ability to, to identify some of these things will determine whether you know the next move of the market or not. So after the formation of the teaser bottom, we saw the market spiking up to this level before it started retracing and then continue with the uptrend. So that is one. That is one confirmatory candlestick that tells us that the downtrend has ended and the market is ready to push to the upside. So when you see that once it forms, don't wait for anything, just immediately, once it forms and then close, immediately enter and buy the market. Since the formation of it is formed at a demand area or close to a support area, immediately you will have to buy the market. Then your take profit should be around the resistance area, of the recent high. So the recent resistance area will be your take profit, which is this area. So when you put the horizontal line there, this area is going to be your area of take profit. Okay, so that is how we analyze the market. That's how we use for an entry point. So first of all, you have to demarcate your resistance and then your support levels in the 4-hour time frame. And after demarcating that, the next thing you have to look out for, come to the lower time frame. Look out for a chart pattern. Look out for a confirmatory or reversal pattern. And an example of it is a teaser bottom. And once immediately it forms, you've got nothing to wait for. Immediately buy the market and have patience. Let your target of the market be the recent resistance area of the market, and then just place it there. Place your stop loss just below the low of the support area, and then allow the market to push. So this is one example you have to learn and make sure you are able to identify that. Now we also have another. Here the market was moving to the downside, and then after the market hit this area, we realize that the market was moving to the downside until the market approaches this support area, which is very close to the actual support area. So when it happens like that, then it means that any significant reversal that is formed at that particular zone, we should be looking out to buy the market. And so what we saw over here was that we saw what we called we saw a pin bar, which is a rejected pin bar or a rejected candle, followed by what? A bullish engulfing candle. And that's also validate that this particular short term downtrend has ended and the market is about to push to the upside. So one of the things you have to be paying attention to is one, rejection. Whenever a market reach or is close to a certain support area or demand area, and we saw a market or a candle being rejected from that area, so it means that the candle is or has respected the zone. And once it has respected and then reject at the zone, any bullish signal that we see validate that that area is still strong enough to buy the market. So after the formation of this bullish engulfing candle, then you enter and buy the market. Your target should be the recent resistance zone on the market. So that is one example I want to we all have to know. I want to check if I will see another pattern we can talk about over here. Okay. Over here, we can also see a bullish harami. We can also see a bullish harami formed here. Here. First of all, we saw a huge bearish engulfing candle formed. And instead of the market to continue to be bearish, because of this resistance area, because of this demand area, we saw the market rejected and then it has respected that area. So we saw this bullish candlesticks formed. And this bullish candlestick formed, which has formed what we call a bullish harami. It is called harami because previously there was a huge bearish candlesticks formed followed by a bullish candlestick, and that bullish candlestick has been engulfed by the previous bearish candlesticks. So it's an opposite side of an engulfing candlesticks. Okay, an engulfing candlesticks. So when the candlesticks that comes before the current candlesticks, is bigger than the current one, then we say that we are forming a harami pattern. So if it is it's at around the bottom of the market, then we say it's a bullish harami. If it is above it and we saw a bullish candlesticks followed by a bearish one, where the bullish one has engulfed the bearish one, then we say we are seeing what? A bearish harami pattern. So with this particular pattern, these two candlesticks has formed what we call a bullish harami. And once you see a bullish harami, just buy the market. At least the next one or two candle is going to move in your direction. And indeed, it will move in the direction, and you will make some points out of that. We saw another bullish harami here. This bearish candlesticks followed by a bullish one, and then the bearish one has engulfed the bullish one, which pushed the market strongly to the upside before the market respected that area. So these are some of the things you will have to pay attention to, and then which is going to help you to know when to enter the market and when not to enter the market. Mr. Henry, please, are you here with us? So that is it. So please, when you are any of these patterns, wherever you see it, it works. Even if it's you see that even at the 1 minute, it means that the next 1 minute the market will move to the upside. The reason why we don't like using the small time frame like the 1 minute is that um you know it's not that strong. So maybe just the next 1 minute will go high, then the next one might move to the downside, and so we usually will want to use at least or a minimum of 5 minutes to make that decision. Minimum of 5 minutes. And also, whilst you are looking out for your chart patterns, also be looking out for your volume. And don't forget that I told you that the volume indicator is used to determine the number of people that are trading at per time. So for example, this particular chart is 30 minutes candlesticks, sorry, 30 minutes chart. So when all the volume indicators that you are seeing represent a 30 minutes candlestick. So when you see a spike in a spike in a volume indicator, then there is a high probability that the market is going to be bullish or is going to be bearish, depending on the color of the spike and then where the market also got spiked from. So if, for example, we saw a spike in a volume around the demand area, then you confirm it with the candlesticks pattern, and that is enough for you to enter the market. So please, is there any question so far? So let's all of us try to understand how the market works, so that even if you are not trading with me and then you are trading alone, you will be able to know when to enter and then when to exit. So please, any question on that? Mr. Jude, any question on that? Please, any question? Okay. So please, when we close from here, I will show you one or two like I'll call you, Mr. Duke. I will call you for one or two discussions. So after the live, kindly I mean I will I will call you for one or two discussions. So please, that is how we analyze the market. So always make sure that the time frame you are trading with, you are seeing something. You always have to see something before you trade. There is this, for example, we look at here. Before this market started pushing to the downside, we saw what? We saw an evening star over here, which is at the resistance area. So we saw, first of all, we saw a small bearish candlestick followed by huge engulfing candlesticks. Sorry, you get it. And after the formation of that engulfing candlesticks, the next one will also be bearish. So immediately the engulfing candlesticks closed, immediately you just have to buy the market. So you have at least, for example, this chart is 30 minutes chart. So you know that at least the next 30 minutes the market is going to be bearish. So you can decide that you use only um one time frame and study the time frame. So you can just be on one time frame for the whole day just to be looking out for an entry. Sometimes one thing that confuses us a lot is that when you flip one time frame to the other, after analyzing from the higher time frame, just stick to a specific time frame. So if you are using the 5 minutes, stick to the 5 minutes alone. Sometimes it confuses when you change the time frame from one time frame, then from there you come to the next time frame. Sometimes the chart you'll be seeing in the other time frame will differ from the one you are seeing in the other time. So that may alter your attention on how you should, enter the or take advantage of the previous pattern. So let's make sure that we stick to um, a particular time frame. So one thing we will be doing as time goes on is that when we start or once we are all set for a live trading, um if we after the analysis of the market, and then as you all know, I always use the 15 minutes for the entry. So we all be focusing on the 15 minutes. We all be focusing on the 15 minutes until we get that one or two 15 minutes candles to trade. And after we trade, that will be it. So I will do my best to make sure that we will all end up being a successful traders. But let's all make sure that we are, putting in, much energy. And then you have to learn a lot, read a lot, because the market, you need to learn the market. And always, any at your free time, just open the chart and be looking at, try to make meaning out of the market. And your ability to identify key levels and then chart patterns put you ahead of almost, majority of traders that we see out there. So that is it. That is it for today. God willing, tomorrow I'll take you through trading psychology. And then trading psychology, I'll make sure I'll take all of us through that. And then we will master one or two things so that we will all know how the market works. And then whenever we enter a market, we know that this and that is what we are expecting, and we will make the right decision for ourselves. So guys, thank you all for joining for today. And then, in fact, today the afternoon live, it was okay. We were able to recover um our losses for Tuesday, and then Wednesday losses, everything recovered. But then if you are here, probably you are still not recovered yet, bet me, you will recover everything. The truth is that let's all make sure that we all risk an amount we can only afford to lose. So when you place a trade and you think that this trade is going against you, always have it in mind that even if you've not placed a stop loss, have it in mind that you can only lose maybe $3 or $5 depending on your account. So you should determine how much you can lose on a trade. So even without a stop loss, once you have that in mind that I can only lose this particular amount. So if you place the market and still the market for some time is not moving in the direction you've predicted, and then it's rather going against you, then you will have to make sure that you close the market and you enter it again. So sometimes leaving a losing market does not make you a loser. By holding a losing market until it blew your account is that is the problem. So when you enter and you feel like you've entered it wrongly, exit and look for another entry. So you always have to make sure that your entries are about 70% of the time correct. You can never have 100% correct entries. So most of the time, every successful trader out there has a winning rate of at least 70%, even 60%, 70%. You will be profitable. Make sure you cut down your losses. You can only afford to lose. You can only afford to lose just a minute part, and then you preserve the other account. So when the market is going against you, we never hope that regardless of whatever is happening, we just have to close it, then we enter again. Like we did this afternoon. We entered and I feel like nah, we have to exit. Take that loss, we enter again. And sometimes you get a good entry, you enter well, and then you take profit. So please, that will be the end of today's live. If any of you have any question, you can let us know, and then we'll discuss that. If there's no question to, we will continue on WhatsApp. So that's the end of today's lesson, and then we'll meet God willing on Friday. That's tomorrow. Tomorrow, the forex market will close, leaving with only the Bitcoin market. So we will trade tomorrow, and then from tomorrow going, we will just stick to our crypto as we've been doing. So that's it. See you, God willing, tomorrow. London session 7:30 a.m. New York session 1 o'clock p.m. Alright, so bye bye guys. If there's no question, then bye bye.